Inflation is back above the Fed's target. That is the headline everyone is running with. And on the surface, it sounds alarming. But here is what that headline is missing. The Fed does not actually make decisions based on that number. They use a different measure entirely. And that measure is telling a completely different story right now. Understanding that gap is not just interesting. It could be the difference between a smart financial move and a costly one. Let's go through exactly what happened this week. The Federal Reserve's preferred inflation gauge is called PCE. That stands for Personal Consumption Expenditures. It is not the CPI number you see splashed across news headlines. PCE measures what people actually spend money on in real time. It adjusts for substitutions when prices rise. It captures a broader picture of household spending behavior. And this week, new data confirmed that PCE inflation has moved further above the Fed's 2% target. Both headline and core PCE have risen. That is the part Wall Street is reacting to. But hold that thought, because the story underneath those numbers is more important than the numbers themselves. There are two versions of PCE you need to understand. Headline PCE includes everything: energy, food, all of it. Core PCE strips out food and energy because those categories are volatile. They bounce around based on oil prices and weather and global conflict. They do not tell you much about long-term inflation trends. Core PCE is what the Fed actually watches when making rate decisions. And here is where the contrarian story begins. Headline PCE has risen sharply in recent months. A big part of that is energy prices, and energy prices have been directly driven by Middle East tensions. This week, WTI crude oil dropped nearly 10%. It hit roughly $75 per barrel, the lowest level since early March. Why? Because the United States and Iran signed a memorandum of understanding. A 60-day negotiation period has begun. Oil flows through the Strait of Hormuz have resumed. More than 12.5 million barrels moved through in a single night. So the energy shock that pushed headline inflation higher is already reversing. That matters enormously for what happens to PCE data over the next 2 months. Now here is where the analysis gets genuinely important. Core PCE has risen more modestly than headline. The data released this week shows that goods prices are firming up slightly. That is partly tariff-related. Imported goods cost more when tariffs go up. That part of the inflation picture is real and sticky. But services inflation, which is the single largest driver of long-term price pressure, has not reaccelerated. Services cover rent, healthcare, education, insurance, and professional fees. These categories make up the largest share of what households actually spend. And services inflation is holding relatively stable. That is not a small detail. That is the signal the Fed is watching most closely. Because when services inflation stays controlled, the overall inflation story does not spiral. It means the current rise above 2% may be temporary, driven by energy and goods, not by a structural breakdown in price stability. If you are finding this useful, consider subscribing for more practical financial insights. But here is where the narrative gets complicated. Bond markets are not buying the optimistic interpretation. Short-term bond yields have risen from recent lows. Markets are now pricing in that the Fed may need to keep rates higher for longer. Some corners of the bond market are even pricing in a potential rate hike, not a cut, a hike. That is a dramatic shift from where expectations were just 6 months ago. And this gap between what the inflation data technically suggests and what bond markets are pricing tells us something important. Investors are not just reacting to current data, they are reacting to the credibility problem facing the Fed right now. New Fed Chair Kevin Warsh has already signaled a more hawkish posture. Markets are taking that seriously. And when bond markets reprice expectations, short-term bond yields move fast. This week, the yield advantage of short-term bonds over cash actually widened. That is worth understanding practically. Felt safe. Money market accounts offered decent yields after the Fed raised rates. But as the Fed cut rates in recent years, cash yields started falling. Now, short-term bonds are offering a wider advantage over cash again. That creates a practical decision point for everyday savers. If you are sitting in a high-yield savings account or money market fund right now, you may be leaving real yield on the table. Short-term bond funds or treasury bills with 1 to 2 year maturities are worth considering, not because they are exciting, but because the math has shifted in their favor this week. That is a concrete, actionable implication most people reading the inflation headlines will completely miss. Now let's think about what actually happens from here. If oil prices stay low, which the Iran deal makes more likely in the short term, headline PCE starts to fall. That removes the energy component, pushing the headline number higher. Core PCE stays elevated but controlled. Services inflation remains stable. In that scenario, the Fed has no clear reason to hike rates. They hold. Rates stay elevated but frozen. That is actually the base case most professional economists still favor. But here's the risk that bond markets are hedging against. If the Iran negotiations collapse during that 60-day window, oil prices spike back. Israel has continued strikes on Lebanon. Questions about Iran's nuclear program remain completely unresolved. That is not a stable geopolitical backdrop. If oil jumps back toward $90 or $100, headline PCE reaccelerates. And a Fed that is already under political pressure to look tough on inflation may find it impossible to stay on the sidelines. That is the tail risk nobody in your news feed is quantifying clearly. So what does this mean at a practical level for different types of people? If you carry variable rate debt, credit cards, adjustable rate mortgages, personal loans, rates are not falling anytime soon. Plan accordingly. Do not wait for rate cuts to manage your debt load. If you have cash sitting in savings, the short-term bond opportunity is real right now. The yield advantage over cash has widened this week. That is not an opinion. It is the data. If you are invested in equities, the services inflation picture is actually supportive. Stable services inflation means the Fed is not forced into aggressive action. That is a constructive backdrop for stocks in the near term. But watch the oil market closely over the next 60 days. The Iran negotiation timeline is the single most important macroeconomic variable between now and late August. If it breaks down, the inflation story rewrites itself fast. The uncomfortable truth about this week's inflation report is this. The headline grabbed attention for the wrong reasons. The real signal was buried in the details. Services inflation is stable. Energy is reversing. Core goods are firming but not spiraling. And bond markets are pricing in a risk scenario that the headline data does not yet justify. That gap between the data and the market pricing is exactly where informed investors find their edge, not by panicking, not by chasing the headline, but by reading the actual numbers clearly. The market is moving fast this week. The next 60 days will tell us whether the Iran deal holds and whether inflation has genuinely peaked. Make sure you are watching.